In the following presentation, Nick Pollard, Managing Director for Asia Pacific at the CFA Institute, and Thomas Ma, Director of Government and Regulator Relations for Asia Pacific at the CFA Institute, share their views on the future state of the investment profession. They identify major trends that disrupt and innovate the world's finance industry, and suggest what new skills investment professionals need in order to build a trusting relationship with their clients.
A little bit about CFA Institute. Our mission is to lead the investment profession globally by promoting the highest standards of ethics, education, and professional excellence for the ultimate benefit of society. Part of our advocacy is around what we call thought leadership, and we have a unit within our organization called the Future of Finance. And they're constantly looking about what's coming down the corner and what can we learn about what's happening in markets to make sure that we are responding in the right kind of way. And today, Thomas and I are going to talk about two publications that have come from that context. One is the Future State of the Investment Profession. This was a piece of work that was carried out late last year and involved questions, interviews with over 1,100 people involved in our industry. So CEOs, practitioners who are maybe portfolio managers, research analysts, and also customers about what they think the industry is doing now and where they think it will go over the next 10 years. And by listening to their answers and talking to them about what keeps them awake at night, we were able to narrow down some of the key megatrends that are happening within our industry, looking at those things that are disrupting what's happening within the industry. And secondly, we're going to finish with a conversation around trust. Trust from the industry to investors, and more importantly, trust of investors to the industry, with some specific comments about what's going on here in Hong Kong, just to see whether you recognize some of those aspects or not. I'm going to give you the background and overview of the Future State in the Investment Profession report. Thomas will then talk you through some of the more detailed elements around future states, around the ecosystem that we think exists between customer, industry, and society. We're also going to look at the trust equation, particularly here in Hong Kong. Okay. Business models are under pressure. Why might that be? Well, we're going through a period of real cost challenge in terms of the delivery of our services to our customers. We're also going through an era, and it's been around really since 2008, of a great lack of trust in our industry, where brands have become under pressure. Brands that used to exist, certainly when I started in banking, many of them don't exist anymore. So the strength of a brand to carry it through this current environment is something that's very important as well. But what does that tell us in terms of what we found from our questionnaire and our interviews? 84% of investment leaders expect consolidation in the industry in the next 5 to 10 years. I was the chief executive of a wealth management firm called Coutts Asia, based in Hong Kong and Singapore, and I ran the APAC office. Coutts Asia is a subsidiary of a 328-year-old wealth manager in the UK and was sold 2 years ago by the Royal Bank of Scotland, its parent, to a Swiss private bank. A bank that you never thought would change ownership has changed ownership simply because the industry has changed, the environment has changed, and the appetite for owning those kind of businesses by multinational banks has also changed. And so there's one example of why consolidation happens. Cost is another example. People are narrowing down how they're prepared to spend their money. And if you're running a wealth manager, for instance, at the moment, more and more of your budget is directed towards compliance and middle office. Less is about product, and even less is about the customer at the end of this. And people will start to vote with their feet. 70% expect investors will increase their allocations to passive investment vehicles. That's again driven by cost. The industry itself hasn't done itself any favors. In fact, our chief executive was speaking at a conference a couple of months ago, and he said the average cost to the customer of having an active relationship with an advisor 50 years ago was about 2%. The average cost to a customer today is 2%. So all the changes, all the investment, all the technology, all the compliance has made no difference at all to how much it costs the customer. And that's because we, the industry, haven't passed on those benefits. And this is a lesson for us, that if you want to stay relevant and competitive, we've got to be much more customer friendly as we move further forward. 52% of our charter holders expect substantial or moderate contraction of profit margins at asset management firms. Again, driven by competition. We have lots of different inroads into the industry, particularly on the artificial intelligence fintech side. And we know that they are absolutely aiming at traditional sources of advice to be able to provide that advice at a much cheaper rate. So what challenges does that give us as an industry? What will jobs look like in a few years' time? And 57% expect institutional investors will reduce costs by insourcing more investment management activities. So in other words, instead of delegating this to third parties, they'll bring them in-house and try and manage them themselves. And that is likely to shrink some of the aspects of the core side of our industry. Changing business circumstances. 73% of investment leaders expect environmental, social and governance factors will become more influential. I'm hoping they are part of your curriculum, but we're seeing more and more emphasis from investment firms now on being much more transparent about how they run themselves from a governance perspective. Who is it who can get onto a board? How diverse are we in terms of the people who work for our organisation? Also, the impact they have on society. Are they focusing on issues that will benefit society, or are they simply about building a balance sheet? And then finally, from an environmental perspective, again, using their annual reports, using their sort of advertising to say, this is what we do, this is the kind of industry we support, this is the kind of world we want to be part of. 70% of investment leaders expect financial centres in Asia will become more influential. Having said that, the importance of reputation has never been more important than it is today. And for instance, one market that's attracting a lot of negative feedback at the moment is Singapore, because it's had a number of scandals that have happened within that. Once you get beyond the tipping point, it's very difficult to come back. And finally, only 11% of investment leaders believe that the investments industry on impact on society is positive. That's kind of embarrassing. It's embarrassing for someone like me who's had a lifetime in this industry, that the vast majority of customers think we haven't been doing any good. And we have a slogan in CFA Institute that's part of our branding that says, let's measure up. And behind that is clearly we, individually and collectively, need to be much better at our jobs. And we always need to make sure we're putting investors first for us to change that dynamic. And then finally, opportunities on the horizon. It sounds a bit doom and gloom, and please don't let me put you off your ambitions for what you want to do within the world of finance. But there are some good things coming around the corner. First of all, 55% of investment leaders expect globalization will offer new opportunities for professionals. Now, we have to hope that the president in the US doesn't do too much to change the attraction of globalization. And 49% of investment leaders expect new technology will offer opportunities for investment professionals. Actually, that's a global number. It's much higher here in Asia, where people are keener to work with organizations who are investing in fintech, who are getting the balance right between fintech and it's all the enabling aspects of fintech with a human touch. Quite often what we're seeing is that the front end of those relationships is still human, but the back end, the information and the data that people are using is where fintech becomes much more interesting. On that note, I'm going to hand over to Thomas to take you through the next sessions.
As Nick mentioned, right, the purpose of the survey is to introduce to you what we think the future might look like. Before we do that, we have to tell you how we see the world today. For those of you who are econ major or finance major, you have seen this chart already before. This is the fundamental of finance and investment in a society. There's no difference from what we see nowadays. What's different is there's actually a third party also involved in this case. You have the people, you and I, who are employee savers of capital, giving money to organizations, asset owners, asset managers, intermediaries, firms. And in return, they give you income, interest, capital gain, stock market increments. These organizations actually work in a landscape that is driven by other factors, right? Economics, political factors, society factors. Back in the days when we look at investment, we don't focus on much about the social benefits. Nowadays, there are green bonds. There are funds in the US who actually only invest in good companies. They prohibit companies like tobacco companies. They don't invest in eco companies more. So, in a way, this is how we should see the society nowadays. What's important also is this trust in the middle. In a sense, when you give money to a bank or an asset managers, you trust them, right? You're giving your trust to them to make good money investment for you and make return. On the other hand, the society also gives trust to the organization in the middle that they will do something right for society. At the same time, there's also what we call a license to operate given to these organizations. For example, Lehman Brothers, Bear Stearns, right? In the past, the society gave them a license to operate as a bank. What happened if they do something wrong? This is gone. And if this is gone, they will be left out of picture forever. So this is how we think you should see this environment nowadays. So we also think about something different. We start to measure what we call societal benefits versus industry benefits. What we mean by benefit society is very simple. Rather than making money for your own purpose, are you doing something good for your society? Are you performing as a good citizen to the society? Has your CSR function doing a great job? Are you hiring enough women? That's what we call societal benefits. On the other hand, we also have what we call industry benefits. Basically, it's, are you making enough money for yourself? Now, based on these two measurements, we have plot 4 scenarios already. On the lower left corner is what we call an absent industry. Basically, we don't need you. You have a very low societal benefit. You don't do much for the society. At the same time, you don't do much for yourself. Now, it's pretty rare nowadays to have this kind of industry. On the other hand, we have something what we call unnecessary industry. You're doing a lot of good for society, but you don't earn enough for yourself. What is the example here? Think about this. A couple years ago in China, there's a company called Alibaba, right? They launched a product called OUHK. It's very simple. In China, most of the savers put the money in the bank and earning some interest. Interest is fixed by government. Alibaba is so smart to figure out, you know what? Rather than giving them money to the traditional bank, give it to me. The bank gives you 3% interest rate. I give you 5%. How does that work? Because in turn, Alibaba make money by investing in another product which earned 8% return. So they are so smart to figure out a way to kind of say, you know what, traditional industry are actually not doing well anymore. These banks are not doing well enough. I can find a way to make this unnecessary industry changing. There are alternative providers, like in my example, Alibaba, kind of changing the world, how it works, to move up the scale to here. So they're earning more now for industry, at the same time changing the world. On the upper left-hand corner is what we call misaligned industry. These are the greedy people who make so much money, but in turn forget about the societal benefits. Example is 10 years ago. We talk about the crisis in the US, around the world. All these greedy bankers, they are making tons of money by selling what they call the toxic assets to the market, which are damaging to society. At the same time, they're earning a lot of big bucks. Finally, is what we call on the top right-hand corner, this is what we want to be. An industry that is not only generating a good return for yourself, but also doing something good for the society. So now you've learned this. The first question coming up that we need your view is the following. In your view, where is the Hong Kong investment industry in relation to societal benefits versus industry benefits? Absent industry, misaligned industry, unnecessary industry, professional industry. Again, I think this is a good way to show that you guys don't really trust the industry, right? I think it also comes back to my comment about the 2008 crisis. I think since then, we are still working very hard to build the trust back from the investors. So this is how we see ourselves globally in a survey. We see ourselves somewhere in the middle. Obviously, there's still work to be done to make sure we're moving to that quadrant eventually. So now that we have learned this ecosystem and where we are now, let's go through this. This is how we see some mega forces, mega trends that will affect you when you start working in a year or two or so. How does these 4 scenarios affecting you? Now, on the left-hand side, we have what we call the mega trends. These are what we call the world changes that not just only finance everybody in the world. How does these 6 factors that will shape the future of the finance professions? Now, some of them are actually quite obvious. I'm sure in your class you have learned that. Aging demographics. Now, I was in Japan earlier in April this year. I attended a conference talk about how they can handle the aging populations, in particular in Japan. They have a very serious aging population. How can they provide enough benefits to these aging populations in the next couple of 10 years? Technology, not just empowering companies, also empowering everybody in the world. Everybody in the room has a phone now. With a phone, you change everything, right? You can do anything on your phone now, ranging from talking to your friends on the phone, go to the web, whatever you can do it. They are changing the world. Organization-wise, it's very simple. In the past, if you ask a CEO of a company, how would they see technology? 10 years ago, they would think it's a cost issue. Nowadays, it is a value-added issue. How can they use technology to earn more money and create value for organizations? Things have changed. In balance of economics, you have the book about capitalism, right? People are talking about the wealth of the nation is not really equally distributed around the world. How should we solve the problem? Government footprint. I'm sure for you guys in Hong Kong, you feel that as well, right? Even around the world, you've seen more and more governmental influences on economic policies, on investment, stock markets. They're everywhere now compared to 10 years ago. Resource management. How can we manage the world populations with not enough resources? Food, water, housing in Hong Kong, these problems come up nowadays. Because of these 6 factors, we believe that there are 4 scenarios that we think you should think about yourself, whether you're looking for jobs eventually or you're working in the industry eventually. How does these 6 factors affecting your working environment going forward? So I'll go through one of 2 of those. Fintech disruption. Now, the word is actually quite interesting, right? I'm sure this word fintech has been in your mind for the past 5 years, right? Everybody heard about the term already, fintech. What's interesting is actually not about fintech, it's about disruptions. At the very beginning, people are debating whether it is disruptions or collaborations between finance and technology. In my example earlier about Alibaba, they are disrupting the traditional bank model, right? They enter into a market with a new product that disrupts the traditional bank saving-taking model. Nowadays, we talk about fintech cooperations. How does a finance company cooperate with a tech company? How do they generate it together? That's questions. But having said that, new technologies still promoting new business model. In Hong Kong, if you follow the news closely, MA is actually licensing virtual banking very soon in Hong Kong, that you can go to a bank without a branch. You can do everything online going forward. Disruptions and creations are actually going on at the same time. Challengers do better than incumbents. In my case, tech companies, Alibaba, do a much better job than the banks. They actually attract more capital. This is important. Disruptions to the world work. Now, I can guarantee you if I'm at your seat right now, based on what I know in the past, I can't find a job because I don't know how to do program. I'm not good at, technology at all. But you guys are. It's causing so much trouble for work already. A lot of people are thinking about re-educating themselves in order to get a job in the future. These are what we think about the implications that will happen. There will be more robo-advisor in the future, replacing human fund managers. There are a lot of process that was in the past handled by human, nowadays can be handled by machine. There's a lot more government regulatory monitoring about fintech. How can they monitor everything nowadays if it's being done by machine rather than human in the past? These are changes that's happening that I think is important for you to understand. With that said, we have another question coming up, which is this question. If you have 1 million today to invest in exchange fund, how would you allocate your portfolio? A, put all money into an AI fund. B, 50-50. C, 100% human manager fund. What's interesting is actually this number. Only 7%, which is around maybe 2% who say they will invest in human fund managers, which is actually alarm for us CFA charter holders, going forward. Most of you guys, somehow trust a machine, right? That's why you put 50% of your capital in an AI fund. We asked these questions to a group of portfolio managers in Malaysia. You know what the answer is? They all picked this number because they had a job. They want to keep the job. But having said that, we also can explain why the difference here. You guys grew up in a tech surrounding environment. At your age, I think you are much more tech savvy than at my age. You trust machine more than human. Understand that. In a way, this also gives us an alarm. Think about the question is, how can we as investment managers going forward, creating value and compete with machines? If an AI fund can do a better job or create more trust from you guys, how can we compete in the future? Which is a very important topic for you to think about in the long run as well, as potential employees in the industry going forward, right? In fact, this is so true. We actually, in our survey, we asked the questions to the retail investors, which is the same as you guys. In 3 years, which of the following do you think will be more important to you? Have access to the latest technology platform and tools to execute my strategy. Have a person to help navigate what is the best for me to execute my strategy. We asked the questions 2 times in 2016 and 2018. Now you can definitely tell a trend's happening. Number 1, a lot more people trust the machines in 2 years' time. If you look at the blue bar versus the purple bar, you see a general increase already. People want more machines. What's also interesting is about this. You can look at the age group. These are what we call the millennials. These are the age 25 to 34 group. As you get older, you trust the machine less and less. So advice for you guys is to think about your career. How would you want to have a career shaped when you start working in industry going forward? Scenario 2 is called parallel world. It's a very simple idea. In the past, finance is for the wealthy people. Today, with the technology advancement, with education advancement, more and more people have access to the investment management service. Think about it. In the past, most of your parents put the money in the bank. They have to go to the bank, line up to get cash out and use it. Today, you can use your phone to pay everything, pretty much. In fact, in Bangladesh, most people use what they call the Beacon to get paid, which is a mobile app that the employers pay the employees on a mobile phone every day, and the phone is a bank for them. So they jump through the bank already. They jump all the way to the mobile banking. With this parallel world, the implication to us is how can we help not just the wealthy people, but also the newcomers? They're looking for something different. They look for different purpose of investment, looking for something different from the past. At the same time, they have more influence to us, whether it is our risk of repetition, geopolitics, women that have a lot more influential nowadays than they in the past. These involvement of more creating an uncertainty for us to handle. How can we handle that kind of changes in the long run? There comes my third question today, which is, do you think there will be another crisis in the next 3 years? If yes, what will be the source of the crisis? Because there will be a national global political risk. Because there's a housing bubble mortgage crisis. Because there's a governmental defaulting on sovereign debt currency crisis. Because there's a cyber attack, hacking. And finally, no, I don't think there's any crisis. I think it really reflects, the group of audience today. They view it about the local market, right? Housing problem seems to be on top of the issue for people, right? When we ask these questions, in Malaysia, in Tokyo, in Pakistan, I think the second choices about the national global political risks are on top of the agenda for a lot of people to think about. This is the answer we get on a survey. Again, as you can tell, national global politics seems to be on top of agenda for a lot of managers, especially the guys in the US. Now we have Brexit, on the line, followed by housing bubble, mortgage crisis, government debt, default. At the same time, these are the APAC retail number that we publish as well. From an investor breakdown standpoint, obviously, I think institutional portfolio managers have maybe a bit more cautious view about the crisis. Most of them think there's a crisis happening very soon. All right, lower for longer. Now, in Hong Kong, we have a rate increase, right? After 12 years of zero rate, now the bank decided to give you some interest on your saving. Having said that, we still believe the lower rate environment will exist for a long time. It's still true that we have seen Federal Reserve increasing rate, but at a very slow pace, at a very controllable manner. We believe that lower rate will keep on for a little while, even in Hong Kong. What does that mean to you? With lower rate means lower return. Basically, it means we have to cater for lower return for longer time. In fact, this is what is happening. There are pressures on managers' fees and margins. We need new client relationship. As I said, if clients like you decide to use the money, put the money for a machine fund because of lower fees, higher return, how can we, as an active managers, manage the money? How can we maintain the client in the long run? What is your value after you're studying finance and get in industry where the client tell you a machine can do better than you? That's a question I think you have to think about that as well for your job. Finally, this is something interesting. It's about being purpose. Nowadays, investors looking for more than just return. They want a purpose. Are you doing good for society? That's something as a managers we have to think about harder as well. Asset owners, collaboration, influence. How would these asset managers, asset owners influence the market, influence the society going forward? Are they leading the society to do a better job for us? Are they disclosing the fee properly? Are they ripping off the clients again? People asking the question now. If you don't answer the question correctly, they walk away from you. So these are kind of the soft sides of investment that people start thinking that will affect you in your career in the future. Now, with all these scenarios to talk about, these are what we think new skills for under these scenarios will help you find a new job. There's an increasing need for soft skills. It's not about how much you know. It's about how can you tell your people you know that. We have seen so many smart people in finance who are so smart at their own jobs, but they can't communicate to a retail client, to a normal person. I'm sure you've seen similar person, right? So how can you explain what you know to your client? Leadership is important. Ability to change. The world is changing at a much faster pace now than it used to be. How could you adapt to the change? We need for more diversity and more interaction skills in group settings. These are the skills that we need. And in fact, these are actually part of our mission, is to help you guys, help the next generations of professionals to develop their skills. In fact, we survey over 1,000 of our members around the world. We group them by investment managers, CEO, and asset owners. We ask them to rank the skill sets here in terms of how they see the importance of these skill sets. The first one, which is almost the top of every job category, your ability to articulate clearly and compelling visions. Can you express yourself clearly? How is your soft skills developing relationship with customers? Obviously, you need to know some financial analysis skills. You have to have an ethical decision-making culture in yourself. Are you asking the question, am I doing the right thing every time when you make decisions? That's important. People look at that right now. My point here is we are looking for people not just have these strong technical skills, but also skills that can articulate yourself clearly to your clients and to the public. Now, with that said, last slide here is about diversity. In fact, we actually think with the diversity background, you actually create better performance. This is proven that we believe is true. We hope that will continue to showcase to our investor community that by involving more female workforce, you will create better results. Okay? Now, with that said, I'll pass the mic back to Nick. He's talk about something even more important, which is the trust.
Final lap, and I promised you there was a second publication I wanted to just touch on, and that's about trust. Because from our perspective, it is the most important aspect of how organizations should be thinking about themselves as they develop. Quite simply, why would you put your money with an organization that you don't trust? You wouldn't go to a lawyer you don't trust. You wouldn't go to a doctor you didn't trust. So why would you put your money with someone that you don't trust? And banks in particular, but all our financial service industry have not taken this seriously enough. They've taken it for granted. So we did a survey. We do this periodically, sort of once every 2 or 3 years. This is the third survey, to try and gauge how trust is changing since the global financial crisis. And if there's a good note here, it is on an average basis across the world, trust is slowly increasing in our industry. Although for those of you who voted that there will be another crisis in 3 years, maybe that will change. You can see there have been some bigger movements in Canada and the US and the UK from a lower base, but it's increasing the trust. You can also see that somewhere closer to home, trust in the industry is falling. So one or two highlights of our survey, and I'll whiz through them quite quickly. Only 58% of Hong Kong investors believe they have a fair opportunity to profit in the capital markets, compared to 69% in the rest of the world. More tellingly, only 48% actually use an advisor. 52% of people would rather advising themselves as opposed to go and see a professional advisor. An erosion, therefore, of the trust between us as a consumer base and the industry that certainly I represent. Across on the right-hand side there, what is it that worries people? Well, paying high fees. I already mentioned to you how poor we've been as an industry about passing on benefits back to customers. Market crash, well, you had your own views on that, impacting my savings. My financial advisor making recommendations that result in losses. And hiring unscrupulous financial advisors. Let me give you, I think, the most shocking statistic that isn't actually on this slide. Only 7% of retail customers in Hong Kong believe that their advisor puts them first. Now compare that to about 60% in China. I think there are lots of reasons for that. Some of it may be cultural. Are you, as a group, very cynical? I think more people in Hong Kong had a bad experience in the last 10 years since the global financial crisis, where certainly China and India tend to be much more optimistic as they've had longer periods of growth and seen significant changes for the better in their own personal well-being. But that's a very sad indictment of the industry that exists here in Hong Kong, and something it needs to wake up to. Because apart from anything, Hong Kong is a global financial center. And just as domestic Hong Kongers have a choice as to who they do business with, the rest of the world has a choice with whom it wants to do business with. So Hong Kong is not competing with itself, it's competing on a very big stage. What do they look for? Where do they get their advice from? Well, they get it from their friends and family. They get it from investment newsletters, and they get it from a primary investment advisor, but as you can see, way behind the rest of the world in the case of Hong Kong. So something to think about. One of the things that, therefore, we're asking our investors to think about is, how do you define trust? What things should you be looking for, either as an institutional advisor or as a customer of the industry, when you're thinking about who should I trust? And we tried to make this something that's more memorable in this trust diagram here. So TRUST, T standing for transparency. Do we have a way of operating that's very clear to you? As a customer of ours, do you understand the communications that we send you? Do you think you understand how we charge fees? At the moment in Australia, there's a Royal Commission that's looking at investor protection, and it's actually looking at mis-selling. Realistic measures. Are you judging your investment manager, your advisor, in a fair way? If you say to them, you've got to beat everybody in the market every time, guess what? They're always going to let you down. Likewise, if they advertise by saying we are the best because we always beat everybody else, they're not telling you the truth. So are you setting targets that are balanced and important? One might be about rate of return, but another might be about frequency of communication, honesty within that communication, the values that they set, are they aligned with yours, which takes us to united values. Do you have the same common values? Does your advisor, does the firm you deal with make you feel this is a worthwhile relationship? How do you feel as shareholders when actually the best rate of return may come from, for instance, investing in the arms business? These are the kind of dilemmas that industries think about, and these are the dilemmas you should make them think about as their customers. S for sustainable and fair rewards. Rewards that are fair, that you understand, and that drive performance. Is that how you see it? Or is this simply a gravy train for the industry to make money out of an unsuspecting and unknowing customer base? And then finally, T for time-tested relationships. The longer you have these relationships with your customers, the more likely it is they'll come back to you. And one thing you may not be aware of, but certainly when I started in banking compared to now, what's the biggest difference? Individual performance of advisors is available on the internet anytime you want to have a look at it. So if you meet an advisor and he or she tells you that they're the best thing that you've ever met, go and Google them online would be my advice, and see what the market says about them, because it's out there. So time-tested relationships, those relationships that are built up over a number of years, and if they're still there, then that's the best sign possible that you've got someone here actually putting your interests first. The trust equation, credibility based on things like an independent declaration of credibility, experience within the industry, how long you've been in the industry, how long you've been doing your job. Professionalism is a little bit more difficult to pin down, but it might be, do they share your values? Do you think they're honest? So more subjective. But the two of them together are likely to generate trust and value, something that you can value yourself, something that you will recognize, and something that will give you the right kind of momentum to invest your hard-earned money with them. So a final question. Which are the most important factors in creating a trusted relationship with an investment advisor?
Full disclosures of fees and costs, has security measures to protect my data, thoughtful about disclosing conflict of interest, providing reports that are easy to read and understand, generate returns similar to or better than the benchmark, charges fee that reflects the value I get from the relationship.
So let's move on. Let's just say a few things about that. The data protection issue is endemic now, not just in our industry, but in the world of commerce. And I'm sure you've been asked a million times to either waive or agree to data protection. When we asked this, I'm quite surprised it's top of this particular audience, having said that. We asked this in Europe, and it was almost down the bottom, and the crowd was very similar to you, about the same sort of age. Investment reports are easy for me to understand, and fee disclosure, they would certainly be at the top three where we've done this elsewhere. So there is some consistency in that context. Okay, we're nearly there. But just to try and ram this home, and just to try and give you some context when you're thinking about trust, both in your academic studies, but also in the way that you pragmatically and practically run your lives. Here's a sort of guide for you to think about when you're trying to ascertain trust. So first of all, in terms of credibility, maintaining a strong brand identity and following through on those promises. So does the brand say and do what it says? Look how long it takes, look how quickly, rather, brands can unravel. Look how quickly Facebook unraveled when it turned out that all your data was everybody else's data. Employ professionals with credentials from respected industry organizations. Now, that's not just an advertisement for CFA, but of course, it kind of is as well. But look for the qualifications that the person has who advises you. Right now, our industry doesn't have one designation that people have to be able to practice. You can be a hairdryer in the morning and a financial advisor in the afternoon, and that's not, by the way, putting hairdryers down. Think about that in terms of what you're expecting. There are plenty of people out there who are properly qualified, but there are an awful lot more who are not. So ask the questions. What has your advisor done to deserve your money? Stay focused on building a long-term track record and adopt a code of conduct to reinforce your firm's commitment to ethics. Many investment firms, many financial service firms will have a code of conduct that they'll publish and say, judge us by this. Many more don't have that. So is there someone policing what your advisors or what your firm does in terms of the way it serves you? Professionalism. Improve transparency and clarity regarding fees, security, and conflicts of interest. For instance, I'm a member of a couple of boards within CFA Institute. I have to attest to every year that I'm not doing something that means I'm conflicted in terms of benefit in a different way. Use clear language to demonstrate that client interests come first. Showcase your ongoing professional development to improve investment knowledge. And demonstrate your dedication to the values that clients hold dear. Understand your clients. In the banking world, there's a dreadful thing called KYC. It means know your client. If you don't know your client, you're not compliant. If you don't know everything about your client, where they live, where their money comes from, how many children they have, you are not serving their needs. So make sure that you understand your clients as well as possible. Our view, very strongly, and just to finish with, is that the firms who succeed in the future are firms who take this seriously. The individuals who will succeed in the future are people who get this. Because one thing's for sure, your future customers are already thinking like this, and they will only do business with individuals or institutions who are on the same wavelength as them. Thank you very much for your attention. It's been our pleasure to be here this afternoon, and I hope you found it relatively interesting. Thank you.